Hey everybody, this is Tchaikovsky and welcome you to another video. This is financial statement ratios part 0.1. We're going to be looking at the thought and the topic here of determining relevance, and we're going to be doing this through common sized financial statements. My disclaimer and copyright notice: the information and opinions of this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Okay. So when we're going through and what's the purpose of doing common-sized financial statements, we don't want to just go through and compute every single ratio. Rather, we want to compute what the ratios that are relevant to our business. And this is very, very important. One of the things that I always, and it's really not the fault of my students, but one of the things that when you're teaching financial statement analysis, one of the most difficult things is that students just want to put through every single ratio that they're given. They don't put thought into saying like, okay, what is relevant for this particular company? And every company is different, but companies within the same industries will have commonalities. But these common size financial statements, what they're going to help us do is to make things more comparable. So let's go through and take a look at this. So when we're going through and doing this, when we're making our balance sheets, we're going to be showing everything as a percentage of total assets. We're going to be showing all income statements items as a percentage of total revenue. Now, one of the things is I'm going to be doing this for Five Below. And I also have a video here, which I'm going to post in the comments below. If you don't know how to go through and to download financial statements on SEC.gov, that's going to walk you through how to go through and to do that. Note that recently the Securities and Exchange Commission stopped allowing or stopped having Microsoft Excel files go through and do this. So what we're going to be doing here is doing these different items on our own. So the first thing that I'm going to go through and do is when I'm preparing financial statements, I want to have at least 3 years of financial statements. Now, most publicly traded companies, when you're going through and you are analyzing them, you may have to pull up I usually pull up the 10K, which is the annual report. Remember, the K is the annual report, the Q is the quarterly report. But as I'm going through and pulling up these different items, I pull up the K, which is the annual report, and then I'm pulling up the quarterlies. Now, as I'm looking at this, I just see here, like, well, this is just a bunch of numbers. And one of the things I had to go through and do with this is that if you notice, I only was able to get on the most recent balance sheet of the 10K, I could only get 2 years of data. So I had to pull up 2 years of prior data. And what you'll notice is you'll see companies will sometimes go through and change up the ordering of the numbers. So you just have to, like, for example, this long-term investment securities was buried in another number. This is 3,802,037. But as we go through and look at these items over here, they just made some sort of like a restatement to then basically have like these long-term investment securities being shown separately over here. So let's go through now and basically take a look at our, let's go through and take a look at how do we go through and make this happen in terms of the common sized financial statements. So the first thing we're going to do is we're going to divide everything by total assets for each one of the years individually. And I'm going to show this here as a percentage. So when I go through and do this over here, I'm showing assets and liabilities as a percentage of total assets, right? So that's what I'm going here and doing. So this is how we're going through and making a common size financial statement. Now, why is this so important to do? Well, for example, if I had a company that said, oh, why don't you look at accounts receivable turnover? Guess what? Five Below doesn't have accounts receivable. So that ratio is completely irrelevant. However, with Five Below, you have inventory. Oh, inventory is about 15% of the total balance sheet. Will inventory turnover be relevant to us? And the answer is absolutely yes. Okay, and some of the other things we might also kind of go through and see over here are concepts, say, such as like debt. And when we look at debt, right, and if we take a look at the income statement for Five Below, what you notice here is that, well, you've got operating income, you've got interest income. Five Below, as of February 1st, 2025, had no debt. So if they don't have any debt, then if we're making the interest coverage ratio for one of our companies, it's not going to be relevant for a company like Five Below. This is why we're going through and using common size financial statements, because it's going to make these companies a lot more comparable. So let's go ahead. We're going to do the same thing over here. We're taking every balance sheet items and dividing it by total assets for that relevant year. Okay, and I feel like Bob Ross, like giving you a little painting, right? So when you see the little dollar signs, and I'm putting this over here by the denominator, this is very old school. And Professor Kasoy, who teaches at Irvine Valley, Carolina, Professor Kasoy always cringes when I'm doing this stuff because she says, Bennett, there's like 500 better ways of doing it. But it's my crappy ass way of doing it until I go through and do the smart thing and take her class, although I think she'd throw me out. So coming over here, I'm going to put this as a percentage. I'm going to go down over here and then show all of these as percentages for this year. A lot of students will make the mistake of copying 1 year percentage to over here. You can't do that because this is fixated over here on the total assets. So we're going to go ahead and do the same thing with January 28th, 2023. And again, we're going to do this over here as a percentage. Okay. So as we're going through and looking at this, what we kind of notice is that the liabilities as a percentage of basically liabilities are roughly remaining about the same amount. The inventory is roughly remaining at about 15% of total assets as well. So their balance sheet is remaining relatively stable. What is Five Below? Well, when I've been teaching financial statement analysis for my wonderful fall, I really like that class. The fall 2025 Accounting 261 class at IBC. Some of the students, I had them do Dollar General and Dollar Tree, which I think may have been a major mistake because in some of the write-ups I got back from the students, they were saying, and they weren't in danger of getting shot. It's just like the stores looked a little bit sketchy. And so if there wasn't a store for them to physically visit in their area, I kind of said, well, choose something else. And some of them chose Five Below. I had no idea that this was a place that was publicly traded. And so my students helped me out. It's publicly traded. So this is actually probably a better and safer company to go through and to do. So I'm doing that one. I'm using this as an example for my students for how to go through and compute ratios. So first stage of common size financial statements on the balance sheet, we're showing everything as a percentage of total assets for that particular year. And again, this is going to help us better assess what's going on with a particular company. It basically gets rid of the numbers and puts it here as a percentage. So it's going to be a little bit easier for us to go through and look at. Now over here for this one, again, what I'm going to be doing here is I'm showing everything as a percentage of total revenue. And what I want to make sure that I don't do is once I get down to earnings per share, I'm just going to leave these alone. I don't put the earnings per share number as a percentage of the total. So over here, I'm going to go through and do the same thing. Yikes. Change this to a percentage, go down over here. And then for okay. So what you kind of notice here is that by going through and doing, these different items over here, what we're seeing is like, well, what's going on the overall bottom line? Why is their net margin decreasing over time? What is the net margin? It's my net income divided by my sales. Okay. Over here, I could also be asking is like, well, the cost of goods sold or my gross margin, which is really my gross profit percentage, is roughly remaining at about 35%, or my net sales minus my cost of goods sold. My selling, general, and administrative expenses seems to be creeping up slightly from about 21% to about 22%. And this again is of total sales. And then I look at numbers like depreciation. Why are they going through and isolating depreciation? It's because when we record depreciation expense, we're debiting depreciation expense, and we are crediting accumulated depreciation on the equipment. Why is this significant? Because depreciation expense is a non-cash item. A lot of analysts will basically go through and they'll potentially go through and add this back. Again, depends on the analyst going through and doing it, but it is a non-cash item. It's not only sometimes companies won't break it out separately, but one of the reasons why a company may go through and choose to do it is because they want to further highlight it on the cash flow. A lot of retailers, such as, for example, Home Depot, will go through and do this on their financial statements as well. Just want to pause really quickly and just kind of show you why this is kind of important to do. So what I've now done is I'm basically taking, and this kind of shows you where if we said that Dollar General and Dollar Tree were comparable basically to Five Below, well, are they really comparable? Are they, similar stores? I mean, yes, they're both kind of like discounted, like dollar stores. And as we look at this over here, what you're going to notice is basically with Dollar Tree, it's the first thing we kind of notice is like, well, dollar Five Below has total assets of roughly, looks like about, these are in thousands, so it's about 4 billion. If we compare that to Dollar General, this is about 31 billion of total assets. What we also kind of look at over here is that in terms of, the long-term obligations. So the Dollar General, they basically, it looks like that they have debt, right? So they do have their interest expense, which would be normal because they do have long-term obligations. So this is also going to help us kind of essentially go through and compare the companies. This over here, Dollar General, if we're saying that this is in fact comparable to Five Below, the merchandise inventories are about 21% of total assets, whereas with Five Belows, it's about 15%. Coming over here, the total liabilities, I always love it when they don't basically break this out, but the total liabilities of Dollar General are going to be roughly, if the shareholders' equity is about 23%, that must mean that roughly about, or let's call this 24%, that must mean that roughly about 67% of Dollar General has about 76 billion of liabilities, or something, 76% of their total, basically they're leveraged by about 76%. So if I looked at liabilities to total assets, it would be about 76%, as compared over here to Five Below, which is only at, roughly their total liabilities are at about 58%. So Five Below is not nearly leveraged as Dollar General is. So as again, why do we look at these percentages? It's like, well, even though Dollar General has a market cap of roughly 30, or assuming not a market cap, but they have total assets of about 31 billion, as compared to Five Below, which is, a much smaller company with about 4 billion of assets. It at least makes us able to kind of go through and to make comparisons by the sizes, right? By putting things as common size financial statements, I'm better able to compare the sizes. Now let's take a look really quickly at the income statements. Well, the gross profit for Dollar General is roughly about 30%. For Five Below, it's about 35%. And one other thing that I also want to kind of look at is if I say Five stock price. So basically the market capitalization of Five Below is roughly about $8 billion. If I look at the market capitalization for Dollar General is about 23 billion. So again, is that, how does this look for Dollar General? Again, if we look over here for like Five Below, they seem to have they came down and then they were kind of going back up again. So, again, these are kind of things we're going to be kind of going through and looking at these companies. But again, the purpose of us going through and using common size financial statements is for us to be able to make comparisons between two different companies. The other thing I will also mention as well is we want to make sure that we're choosing companies that are in the same industry, right? You don't want to be, if I was comparing Five Below to Meta Platforms, you'd look at me and say, Bennett, you're absolutely nuts. And you would be correct. They're two completely different companies. Meta is in the social media space, much harder to compare it to a company like Five. You can't really compare the two companies. So in any event, hopefully you have found this to be helpful. I look forward to seeing you on the next video. Have a great rest of your day. And I don't know if this stuff works in terms of liking and subscribing, but appreciate it if you do. And if you have any questions, you can always email me at 1812cpa@gmail.com. Have a great rest of your day.